the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements on the SGX. While Singapore shares moved higher today amid mixed trading in Asia as investors mount the impact of new US tariffs. Now, the Straits Times Index was up 0.82% at 4,188 points at about 2:23 p.m. Singapore time, and that is with a value turnover of some 865 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. The STI ended 1.04% in the green. We're looking at 4,197 points. In terms of value turnover, that's 1.5 billion Sing dollars. Gainers outnumbered losers, 361 versus 206. Top advances for today we've got for you GMXUSD, UOB and DBS. And top decliners we have here Powermatic Data, Avaga Limited and Micromechanics. Well, in terms of companies to watch, we have CDL or City Developments Ltd because its executive chairman Kwek Leng Beng told the Business Times that his plans are for the group's portfolio of hotels to reach the 500 mark. Now, elsewhere from how BYD shares fell in Hong Kong trading on the back of sputtering monthly sales growth, to US market movements after a weak July non-farm payrolls report out on Friday and how Trump fired the Commissioner of Labour Statistics after the reading was released. We've got more corporate and international headlines in focus. Now let's break them down with David Kuo, co-founder of The Smart Investor. He joins me on the line. Mr. Kuo, how are you?
I'm very good, Jen. How are you?
Good. So many things going on. I feel like I'm a broken record. I've been repeating the same thing again and again. So many things going on indeed. And speaking of which, let's start with the U.S. this time around. Mr. Kuo, U.S. President Donald Trump had on Friday fired a top Labor Department official, the Commissioner of Labour Statistics, in fact, on the heels of a market-shocking weak scorecard of the U.S. jobs market. Now, let's talk about the weak non-farm payrolls numbers for July. How have investors reacted to the news? And with Trump firing the Labour Department official, what questions will the move raise about the quality of U.S. economic data going forward? How concerned are you about this?
Well, the market didn't like it at all, Jen. And I don't understand why they didn't like it, because I think the writing was on the wall anyway, but they didn't like it. And the reason why they didn't like it, Jen, was because they see that the U.S. economy is beginning to soften. And the fact that it is softening can be traced all the way back to the Trump tariffs. Essentially, businesses in America are saying, why do we need to take on people if we are not going to need them? So consequently, those payroll numbers were much weaker than expected. Now, Donald Trump didn't like what he was hearing, and so just like a baby who doesn't like what is happening, throws the toys out of the pram. And this is exactly what he did. He fired the economist who produced those numbers, and he thinks that this will make things better. I think we have to understand that, this is only 1 month's worth of data, but the trend has been showing that jobs growth in America is beginning to soften. And so he better learn to accept the fact that America's job market is beginning to weaken. Just by firing the economist isn't going to make things any better, because a long, long time ago, Abraham Lincoln said, you can fool all of the people some of the time, some of the people all of the time, but you can't fool all of the people all of the time. And just by firing the economist doesn't mean that the economy is going to get any better. People will be able to feel it. They'll see their next-door neighbor losing their jobs, and they'll say, what is going on here? And when am I going to lose my job? And that is when you start the beginning of a downturn in the economy, or a recession in this case.
But doesn't that press the case or make the case for Fed rate cut, which was what Trump had always wanted, isn't it?
Well, you've got inflation at the same time. You're beginning to see that the inflation numbers are still high. The problem with the Federal Reserve is that it's got this dual mandate. It's got to ensure that there is price stability and also full employment. It is very difficult to walk that tightrope. The way I see it is, probably at some point in time, they will say that the labor market, the jobs market, is more important. And so we'll worry about inflation later on. If that were to happen, then I think inflation is going to start rising because the Fed is going to be cutting interest rates as you have suggested. And I'm not saying that either you or the Federal Reserve is wrong, but I'm just saying that when you have a dual mandate, what exactly do you do? So maybe they will lean towards the jobs market and say that is going to be the more important. We don't want loads of people out of work, so we're going to cut interest rates. But it also means that inflation could then take off. And quite frankly, if that were to happen, then you and I and the rest of the world will have to look after inflation ourselves.
Okay. A lot of things influencing markets, but how far did the cautious mood in the U.S., as far as we see with Wall Street and also with stock futures, how far did that cautious mood filter through to Asia today as investors here in Asia also digest Trump's new tariff rates? How far did the STI track regional movements, mixed movements, in fact?
Well, the STI did reasonably well today, but it was only a handful of stocks that did well. I mean, we're talking about the likes of Jardine Matheson, Singtel, Semcor. I mean, those are the kind of companies that reasonably well. But these are sort of safe investments for people. So maybe people are adopting a kind of risk-off approach and saying, we're going to plump for these kind of companies at the moment. We don't want to be out of the market entirely because we know what the market is. It is totally unpredictable. And at the moment, there seems to be some suggestion that maybe the American market could rebound this evening, in which case people don't want to be out of shares right now. And also, as you suggested earlier on, Tian, the Federal Reserve could cut interest rates in September, which therefore means that risk assets, in other words, stocks and shares, could become attractive. So you don't want to be out of the market, but at the same time, you don't want to take huge amounts of risk either, because you know that the American economy is beginning to soften.
Okay. Now, Mr. Kwok, let's zoom in on some of the companies to watch for today. We have CDL, City Developments, because its executive chairman, Kwek Leng Beng, told our colleagues at the Business Times that his plans are for the group's portfolio of hotels to reach the 500 mark. How far was that within your expectations, and how far does it augment the outlook for the firm?
Well, how shrewd is that? I mean, ultimately, Kwek Leng Beng is a master as far as running a company is concerned. And what he's saying is that, I have a construction company. I need to build buildings. But the problem is, if I build them, are people going to come out and buy them? But in this particular case, what he's actually looking at is recurring revenues. Now, if I was a builder, I build a building and then I run it as a hotel myself. It therefore means that I am going to be getting recurring revenue from this. But his plans are very ambitious. He's talking about trebling the number of hotels that he's got. And so he is banking on the fact that maybe global travel, worldwide travel, is going to remain relatively strong and that there will be demand for hotel rooms around the world. I mean, it wasn't that long ago I was at one of his hotels, eating that is, not living in London. And it was an outstanding hotel, really top of the shop, top of the class. And this is the area that I think he's planning to move into. Good quality hotels, segmented properly so that he can either choose to address the business traveler, the well-heeled traveler, or maybe the younger generation. And he's got this whole suite of hotels. And I think it's such a clever move for Kwek Leng Beng. I take my hat off to him. He's done exceedingly well.
But is that 500 target realistic in your opinion?
Well, it really depends. I mean, the world is a big place, Tian, and there are hotels, there are demands for hotels all over the world. So whether you're looking at Asia, whether you're looking at Europe, whether you're looking at the US, there will always be demand for hotel rooms. But the interesting thing is, how do you segment your hotel so that you don't end up being a Me Too hotel, something that is different, and it is a place that people want to travel. And quite honestly, I mean, that brand is very strong here in Singapore, and I'm sure if there are Singaporeans traveling abroad, they would probably want to stay in a Millennium Hotel, Millennium and Copthorne Hotel, because they know that it is a homegrown brand, and Singaporeans are traveling quite a lot now. Not just in Asia, but certainly in Europe and America as well.
And Mr. Kwok, what are the companies you're setting your sights on for this week? I mean, after all, earnings season is in full swing. We've got earnings due out of blue chips, including UOB, DBS. We've got Genting Singapore, Semcor, SGX, not to mention the REITs, including CapitaLand Integrated Commercial Trust.
Well, I will be definitely looking at the REITs today. We just had results out from Ascendas at the moment, so I'll be having a look at that a little bit more closely. But the results look okay from Ascender Capital and Ascender Street. But there will be many more REITs that will be reporting this week. And I think in general it will be steady as she goes. The banks, on the other hand, are going to be interesting because we saw that the OCBC results beat expectations, but they were lower than this time last year. So maybe the banks are going to be coming under a little bit of pressure with regard to that net interest margin that everybody seems to focus on. But the important thing for people to focus on isn't so much the net interest margin, which is that difference, the profit that they make from lending money versus what they have to pay in interest to savers. What we should be looking at is the fee income. And I think many of these banks are going to be making quite good fee income. Whether it will make up for the loss in the net interest income remains to be seen. I don't think it will, and so maybe some of these banks could report slightly lower profits, but as long as the fee income is holding up, then I think we are on to a good thing.
If you're just tuning in, we're in conversation with David Kuo, co-founder of the Smart Investor. Mr. Kuo, let's talk about BYD across the region. BYD shares fell in Hong Kong trading today as sputtering monthly sales growth that raised doubts about whether the EV maker will meet its annual target. Now, BYD said on Friday that it delivered some 344,000 vehicles in July, up 0.6% from a year earlier, but down 10% from June. Any thoughts on the latest numbers?
Well, Ken, when we first heard about electric vehicles, when I first started talking together with you on this show, we were saying the electric vehicle market is one that's got very low barriers to entry. When you get a phone maker like Xiaomi suddenly deciding that they want to move into the car market, it tells you how low that barrier to entry is. And because that barrier to entry is low, it means that the only way that you're going to be able to sell an electric vehicle is sell on price.
Yeah.
You have to cut the price. But at the same time, the Chinese government doesn't want these companies to sell on price. They don't want them to cut price and start this price war, but they have no choice. And the problem with electric vehicles, and I've mentioned to you this before,
yes,
it is like all the electronics goods. They drop in value significantly in a very short period of time. Today's plasma screen TV will be obsolete in probably a year or 2 years' time. People won't want that anymore. They will want something that is new. And that, I think, is the problem with electric vehicle manufacturers, that the price of that car will drop in value very, very quickly, and so people don't really want to pay an awful lot for it because they know that they're going to be losing money as a result. It's not like the old days when you had the internal combustion engine cars that depreciated at a relatively slower rate, but these electric vehicles, today's EV will be obsolete tomorrow when somebody comes up with a better all-singing, all-dancing vehicle that may be able to sort of make you coffee whilst you are driving your car. That, I think, is the problem with EVs.
Okay. And further away, Mr. Kuo, from EV, quite ironic, we're talking about oil prices now. Oil prices extended declines today because OPEC Plus on Sunday, they agreed to raise oil production by 547,000 barrels per day for September. The latest in a series of accelerated output hikes to regain market share. What are the levels to watch for oil then?
Well, I think it's anybody's guess. I mean, anything around about $65 a barrel would probably be okay for most of the oil-producing countries. It may not be great for America because I think it's going to cost them more in order to get the oil out of the ground in America. So drill, baby, drill could be replaced by fill, baby, fill. Because I don't think the Americans are going to be able to drill for oil at these kind of prices. They won't be able to compete. But the reason why oil prices are falling, Tian, is because the global economy is going to go into a slowdown. I mean, is that really so surprising? When the economy slows down, people need less oil. If they need less oil, then it therefore means that oil prices are going to come down. So in the case of OPEC, what they want to do is to increase their market share. And what they are going to do is to say we're just going to pump more in order to try and sort of gain that market share. But it could drive down oil prices, which then hurts themselves at some point in time. And so what they may have to do then is to start thinking about increasing prices again.
And finally, before we let you go, Mr. Kuo, we've got earnings due out of Palantir Technologies and AMD in the first half of this week. McDonald's, Uber, they're set to report in the mid to later half. We've got big pharma players as well, Eli Lilly and Co., Merck and Co. reporting. How would you prioritize what to watch as always?
What do you think, Jen? Which one do you think I'll be watching most of all out of all of those?
If it were me, I'll look at AMD first, followed by the pharma players, followed by McDonald's on the state of the U.S. economy. What about you?
I'm glad you said McDonald's, right? Because that will be the one that I will be looking at.
So that's the first one.
Well, no, because I think McDonald's is the barometer for consumer spending.
Yeah.
And I think it is a barometer not only for American consumer spending, but a barometer for global consumer spending.
Yeah.
And remember what we said earlier on about those Trump firing his economist that came up with those bad numbers. You can fool some of the people some of the time. But companies like McDonald's will tell you as it is. And if they say that the consumers are feeling constrained, the consumers are not spending money, then that is what you need to be focusing on. And I think in the case of McDonald's, they will tell us what the American consumers are doing, how their $5 meals are performing at the moment, and will they at some point in time have to start thinking about a value meal that is less than $5 in order to attract those consumers. So, yeah, for me, I think it will be McDonald's first of all. Then I'll have a look at some of the pharmaceutical companies to see what they have to say about the tariffs for pharmaceuticals going into the U.S. And then maybe AMD. Yeah, so that's the order of priorities for me, Jen.
All right. Thanks so much for the insights, Mr. Kuo. That was David Kuo, co-founder of The Smart Investor. Thank you so much for joining us today on Money FM 89.3.
Thank you.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.